What's going on, guys? MMunizBOG here. Welcome back to the channel. In today's video, we're going to discuss two dividend ETFs, JEPI and DIVO. Now, these are more commonly referred to as DIVO and JEPI. And in this video, more specifically, we're going to talk about the objectives of the funds. We're going to look at how they've performed. We're going to talk about their holdings. We're going to go over who these funds might be a good fit for. And then last but not least, as with all my videos, I'm going to give you my personal opinion on how this fits into my strategy or if it's in my portfolio at all. Now, one thing to remember is I am not a financial advisor. I only make these videos to help you and your family see what options you may have when it comes to setting yourself up for success in the future. Now, you may have noticed my voice is a little bit different today, and that is for two reasons. One is I finally fixed the audio issue that has been occurring in my videos. So thank you to the guy that mentioned that to me. You are awesome. That is now fixed. And also, I have a cold, which that's not as good news, but it is what it is. So if you work hard for your money and you want to make it go further, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. So first things first, we're going to break down each ETF. Starting with DIVO, we have an actively managed ETF from Amplify ETFs that's actually managed by Capital Wealth Planning. Now, DIVO seeks to provide monthly distributions from the assets that it holds, which are typically dividend-oriented stocks that show growth over a long period of time. So large cap dividend stocks. A lot of them are going to be dividend aristocrats. This fund also attempts to write covered calls strategically and targeted on specific assets it holds based on when the fund managers feel is a good time. So what I mean by that is if one of the fund managers finds out that one of the assets is going to be a little bit more volatile because of something that's going on in the economy, they may write a covered call on that specific asset. They're not writing covered calls on an entire index or on all of the holdings, only strategically when the fund managers see fit. So that's very different. And also, DIVO's pretty transparent about what they do. You can go into their holdings and you can see exactly the dates for their covered calls. You can see the strike price, everything you need to know. So these monthly distributions are going to be a mixture of dividends from the actual companies and then also premiums from the covered calls that the fund managers chose. Now, when it comes to JEPI or JEPI, we have an actively managed fund that is a lot less transparent from JP Morgan. Now, the objective of this fund is to provide an investment tool for investors that provides monthly distributions with decreased volatility when compared to the overall stock market. So this one is going to focus more on large cap stocks, not necessarily dividend paying, but just less volatile in general when you compare it to the actual market. Now, do note that when they claim reduced volatility, that does not mean that there's anything to protect you from a crash. There are no put options or anything like that. All they have is covered call options that are actually written through equity-linked notes, and you do not have any way of seeing them because JP Morgan keeps that information pretty secret. The only protection you're going to have in a down market, even against what it claims, is you're going to collect the premiums from the covered calls that they wrote, but the assets are still going to drop. So all in all, JEPI also provides monthly distributions, which will be a combination of dividends, not quite as much, but also the premiums from the covered calls. So one thing to keep in mind is, unlike other covered call income ETFs that we discuss on this channel that do not have capital appreciation or a chance for it, these funds do because they don't write covered calls on the entire fund. JEPI typically sticks with 20% of its fund, and DIVO can vary pretty drastically, typically around the same amount though. So all in all, both only do covered calls on a small portion of the total assets. Now let's look at a quick comparison of the two side by side. We're going to talk about a few other things. So now the price for DIVO as of March 23rd is $37.38 and JEPI is $60.75. Now DIVO's been around for quite a bit longer, almost 6 years, and JEPI is actually really new with less than 2 years. However, one thing to note is that if you use the mutual fund JEPIX, then it has been around for a significantly longer time. Now, the assets under management is a lot less for DIVO, and JEPI is getting almost $7.5 billion. Now, one reason I started highlighting some of these green is because that means it's clearly the winner. Some people will have preferences, but there's really no doubt when it comes to expense ratio. If DIVO has a 0.55% expense ratio, JEPI has 0.35%, that is significantly less, which means investors can keep more of their money. The reason that DIVO has a higher expense ratio is because there's a lot of turnover amongst the holdings and the fund managers are constantly doing things. JEPI is definitely the win there. Now, the number of holdings, this can be seen as a positive or a negative. 20 to 25 for DIVO and around 100 for JEPI. So the good news with DIVO is if you've chosen good stocks or good assets and they're going up in price, that's great. With JEPI, you're going to find a little bit less volatility. If one company goes under, typically it's not going to be affected too much since you have 99 others, or around that number. Now the trailing 12-month dividend yield is significantly better for JEPI once again. So it does look like the winner when we look at these important stats. However, this doesn't tell the whole story. Now when we look at the 4-year return, and the reason I did that is I have a portfolio visualizer that we'll go over later on in the video, but you have a total return of 51% versus 38%, and that's when we include dividends or we reinvest them. So DIVO actually wins because it has a lot more capital appreciation when compared to JEPI. So JEPI pays more on a monthly basis as an income ETF, but DIVO may be a bit better if you're looking for growth or capital appreciation. Now, beta is a way that some people like to measure volatility. So a beta of 1 would be like the S&P 500, but JEPI has 0.66 and DIVO has 0.78. Technically, most people would like less volatility. However, remember, less volatility means that yes, it's not going to crash as much, but it's also not going to go up as much. So you can take that or leave it. I don't think one's a clear winner here. But yes, DIVO is a bit more volatile. Now, both of these are covered call ETFs. And like I mentioned, DIVO is pretty transparent. They target specific covered calls and it ranges. It can range from 30 to 50%, sometimes 20%. And then JEPI, there's not much information, but it's typically around 20% of the total portfolio, and they are in equity-linked notes. When we talk about taxes, we can look at the actual report from DIVO, but I couldn't find one on JEPI, and I actually don't own any JEPI, so I can't give any background information. I do own DIVO, and I can tell you that it is a mix of ordinary income, it is a mix of qualified dividends from the assets that they've held for a long time, and then it's also a bit of return of capital. So you have a healthy mix of everything, whereas JEPI is going to be a mix as well. So now that we talked about the inner workings of these funds, let's take a look at their actual performance history. One thing to note, of course, is past results do not guarantee future results, but they do allow us to forecast out trends for the future and potentially make decisions based on how we think they'll do. So let's take a look. So what we have here is JEPI in blue, and then in orange we have DIVO. Now this goes back from September 2018 up until February of 2022, and we can see how these two funds do. Now you'll notice that even though JEPI claims less volatility than DIVO, there's really, in the big crashes, like right here back in March of 2020, they both crashed at almost the exact same amount. And the reason for that is, even though they claim different strategies, a lot of the holdings are similar if you actually go into each of the holdings that they hold. But at the end of the day, as we talked about, DIVO's overall growth and capital appreciation or total return has been better when we reinvest dividends. So if you had invested initially $10,000 into both, at the end your cash would be $15,000 in DIVO, or it'd be just under $14,000 in JEPI. Now keep in mind, just because we see a graph that looks better for one or the other doesn't mean that JEPI is the actual loser or DIVO's way better. Personally, for me, I do believe DIVO is the better pick, only because I like the idea of how they invest in their funds more than how JEPI does. I personally prefer the assets that have shown dividend growth over time, and they're both large cap stocks. So I like the dividend growth, and if you look at DIVO's dividend over the past 4 years, it has slowly grown as well. So it just seems that the strategy that they're trying to follow is working. Whereas when you look at JEPI, you'll see that the dividend's a bit harder to tell if it's actually going up or down or just staying the same. And JEPI, nowhere does it claim that it's trying to grow its dividend. So I'm not really a fan of that. Now, another thing about me personally, I do invest in DIVO, and I like it to be a complement to two other funds that I have, which are SPHD and SCHD. I do like having a large portion of my portfolio in dividend ETFs, and the reason for that is I like monthly income or quarterly income from SCHD. I find it's an easy way to manage my finances. It helps keep me positive when I'm investing. I don't care as much if the funds are going down or up because I know I'm getting paid. If you do strict math and you look at just the numbers, yes, you will be better if you invest in something like QQQ or the S&P 500. You won't have as high of dividends, but you'll have higher capital appreciation over time, and you'll have less taxes to pay. That's fine if that's what you want to do. But I like to have a balance between both, and that's just me. So all in all, these two funds are great for someone that wants high dividends or someone that's already retired and needs the higher income, definitely a good fit for them. Both funds are good complements to a portfolio. Neither one of them should be 100% of your portfolio because diversity is key when it comes to having a strong portfolio and protecting yourself in the long run. I've mentioned it before and it's all over Reddit. The Quadfecta is one of the most popular retirement portfolios, and that's just a mixture of Q Yield, NUSI, DIVO, and JEPI. They have those 4 funds to diversify their portfolio, and it seems to be working well. So I want to know from you guys, what are you guys currently investing in? Do you like DIVO? Do you like JEPI? Tell me in the comments. I do my best to answer every single comment, and I look forward to seeing you guys in the next one. Take care.